Everybody, welcome back to part two of my Tesla 4Q 2024 estimates deep dive. So we previously discussed regulatory credits. Now we take a sort of a long-term look how regulatory credits have developed. My estimate for 4Q, as you saw in the previous episode, was 824 million. And when you see this is in line with the long-term trend, and you can see that Tesla's credit sales used to be have been quite volatile. But what we saw recently was sort of a step change. We had this all-time high, which was followed by yet another all-time high. This never happened before, and this is a big reason why I think we will see actually quite high credit sales yet again. And this is more a, let's call it a statistical observation, but this is also backed up by commentary that we received out of the industry. And this is mostly driven by large automakers not achieving their electric vehicle sales. So what happened in 2024 is a lot of them accepted that reality and basically moved on, which meant they bought more credits from Tesla. So this is fundamentally what is driving this bullish 4Q outlook on credit sales. Then we move on. This is credits shown in trailing 12 months. So the last four, so you sum up at each point, you sum up the last 4 quarters and how this, so it's basically an annualized number on a rolling basis, as it would be called. And you can see Tesla has seen some periods of fairly consistent trailing 12 months credits revenue, and then it had a spike, traded for quite some time around that level. And then recently we saw a spike up again, and this is further, let's call it as the statistical observation of likely sustained higher levels. But of course, it depends on how this plays out with the new administration in place. So then let's move on. So on this slide, we move on one step further in the P&L, and we now go to automotive leasing sales. And first of all, the leasing revenue that you see here is not the leasing revenue just of that quarter. It's also leasing revenue that was originated in prior quarters. So it's basically the quarterly revenue of often quite a few quarters. And so this has some interesting dynamics. So there's an element of runoff. So every quarter some old quarters are dropping off. And as they drop off, you have then the new vintages that are being added. So you have a kind of a runoff effect you need to account for. And what you can see in the numbers is that for basically over 2 years, you had a sustained decrease in leasing revenue. And this had to do with Tesla deciding to use less and less of the leasing sales lever until this quarter. And we will see in a second more clearly how this played out in terms of quarterly leasing rate. But you see, my modeling suggested for the first time in a long time, we have actually a meaningful sequential uptick in this line item. And then if we look at what this means in terms of leasing rates on this slide now, these are all disclosed numbers by Tesla. There is no forecasting on this slide. And you can see that here is the SX and Cybertruck product lines. Tesla bundles them, so we don't know leasing rates for each vehicle, but we can see this spiked significantly from just 1%, which is basically nothing in the automotive world, to 6%, which is still very, very low for an automotive company. But then importantly, the 3 and Y product line, the main product line, increased further from 3% to 5%, and that has a much more material impact than this jump from 1% to 6%. And on this slide, we actually see why I believe Tesla all of a sudden is increasing the leasing sales lever so much, because you could ask why didn't they use it earlier. And so this is data from Cox Automotive, and they created something which they call the Mannheim Used Vehicle Value Index, and this shows you trends in used vehicle prices. And I've did an analysis, and that trend is broadly applicable to some other very important markets. So you can look at this, because this is only for the US, but you can also use this as a rough guide for sort of global trends. It's not perfect, but it gives you a decent idea. And what you see is there was this massive spike up in 2022 before in used vehicle prices. This was caused by COVID. There were production shortages, so people couldn't get the new vehicles, so they resorted to used vehicles, and there was an increase in demand. People didn't want to sit with other people in public transport, yada yada. There were all these kind of one-off effects led to a skyrocketing of used vehicle prices. Anyone who was in the market for used vehicles at the time probably will remember. And then we're a significant, let's call it, deflation of these prices, which hit particularly hard electric vehicle prices, because electric vehicle prices, especially Tesla's prices, skyrocketed, and this then sort of amplified the downturn. Sort of the reversal was then more pronounced, but this trend finally ended, and we saw, and you have to keep in mind it's a very long scale, so this is a fairly long time period. So we saw this bottom, and Tesla basically waited for a few quarters to see whether this is really the bottom, and then they started to increase uh, leasing sales. And the reason why you don't want to have a lot of leasing sales during a period of very high used vehicle prices is because, one, if you when you price a leasing rate as an automaker, you need to make an assumption of the residual value. So if you assume a very low residual value uh, relative to the high new price, then the leasing rate will be very high, and therefore highly unattractive. On top of that, keep in mind that there's an element of financing in there. So higher financing rates, which were the case around this time of the year, um, also meant the leasing rate would be higher. But then we saw rates coming down a bit, and then the used vehicle market kind of reached a bottom. This allowed Tesla then to use a more aggressive residual value assumption, and therefore generate more attractive leasing rates, which then really made the leasing sales lever for the first time a viable option. Because the problem is, if you have dropping used vehicle prices and you don't really know where the floor might be, you run the very high risk that you have a too high uh, used vehicle price assumption or residual value assumption. Therefore, you underprice the leasing rate, and then when the vehicle comes back to you, the lease return vehicle, you 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 have to take a write-off. And how bad this can turn out, we, for example, saw in BMW's 1Q 2024 cash flow, which was significantly negatively affected by way too aggressive leasing. Leasing is extremely important to BMW's business model, and therefore had a massive impact on BMW's cash flow at the time. So Tesla is clearly quite prudently managed in this regard. I can tell you when I compare this aspect with many other automakers. Then we move on. So on this slide, we finally look at the total automotive revenue that includes leasing and includes credits. And so here in the P&L, this is where we find this line item. And you can see there was some sequential increase, plus 1.4%, suggests my modeling, but a roughly almost 6% decrease year on year. And this is so here on this slide there is no additional assumption. This is just adding up all the separate components we discussed already: automotive sales, automotive regulatory credits, and automotive leasing. And this is the outcome. So therefore here is no additional modeling. So we can move on. And now we get to the, from my perspective, most interesting piece of the 4Q deliveries and deployments disclosure, which is the energy storage deployed. And this came in at an all-time high 11 gigawatt hours. This is crazy growth, and I think it's worth spending a second down here. I'm sorry, I have here a typo in the slide. This should be 2024, 2023. This is correct, and this should be 2022, obviously. And you can see this item grew in 2022 71% year on year, then shocking 125% in the 2023, and in 2024 we grew again over 100%, which is crazy. And you have to keep in mind the Shanghai, the new Megapack factory in Shanghai just went online. They started trial production, and keep in mind this is for the first time a purpose-built factory from scratch from Tesla making Megapacks, including all the learnings they collected over years from the current single Megapack factory, which I think was a was an existing facility, so not purpose built from scratch. So and this I think a good model to use is maybe the Fremont factory and the Shanghai factory. I mean, people who studied these topics for a long time, they know that the Shanghai factory is vastly more productive than the Fremont factory. Why the Shanghai factory was built with all the learnings of how to make mass market electric vehicles, while the Fremont factory was an old ICE vehicle plant taken over by Tesla and just modified to sort of make it fit for their needs. So and then also when you look at satellite pictures of the Shanghai Megapack factory, we know it's much larger. So this will be likely a much higher output factory. So this is very, very exciting. And also we know from the Chinese, they ramp very quickly. So for all these reasons, and I've been saying this for a while, the 2025 financial story, like literally what hits the P&L, will be the energy business, because this is a much higher margin um, um, a product segment compared to automotive, and we are now getting to a point where becomes a significant needle mover, and given its exceptionally high growth rate, um, this is very interesting. On this slide, we see the underlying pricing assumption, and what you have to know about energy storage. It has basically two components. People always talk about the Megapacks business, which is the B2B, so business to business product, and obviously. And then there's also the Powerwall. The Powerwall is a B2C, is a business to consumer product, and and Tesla will generate most of the revenue, obviously, with the Megapack product, but we should also not ignore the Powerwall product, which helps to maintain a higher average kilowatt price per kilowatt deployed. Although this is, think of this like the Megapacks are like the 3 and the Y. It's like really the large volume mass market, but lower average selling price product. And then you have the Powerwall, which is kind of the high average selling price Cybertruck product, and but much lower volume. And this is but when you run the numbers, you can see that these significant margin deltas, they also drive a meaningful uplift in average margin, because I expect the Powerwall to have like quite attractive margins. The Megapack margin is is still also quite attractive. However, when you look across the broader sort of megapack industry and Tesla's competition, they just offer megapacks at vastly lower prices, and at some point Tesla will have to lower their megapack prices. You're probably not going to see this on the configurator on the website because these are very large projects. These customers buy very large amounts of megapacks, and therefore they will get, I would expect let's call it a customized price, and therefore we can't look at the website. We need to look at what do us the implied revenue numbers tell us, and for example, the implied revenue per kilowatt hour was $317. However, there's one other quirk we have to keep in mind. When Tesla sells these large projects and these megapacks, there is an element of deferred revenue. So when you look at for each quarter the average implied kilowatt, it's not just for the kilowatts deployed that quarter, but also the deferred revenue from prior quarters kicking in or is being recognized in that quarter. And this also helps to maintain a high average kilowatt price, even though you see in markets for new projects from some Chinese competitors prices that are even below $100 per kilowatt. So you would say, oh, this is a crazy high assumption. But again, keep in mind all these margin improving factors. And by the way, this number is basically the energy storage equivalent of the average selling price in automotive, just to give you like a mental construct. And this I expect to help sustain this price, but going forward, I expect this to significantly come down. But then there's another important factor to keep in mind in terms of what this means in profitability, in terms of profitability, because you have also the Shanghai Megapack factory coming online, and this factory we know, just like the Shanghai-made vehicles, will have a significantly lower cost. So it's fine for the average price to come down if your average cost also comes down. And because Shanghai Megapack factory will make megapacks much cheaper, it's actually in terms of profit not such a big deal. And we'll get to this in a second. On this slide, we look at what this actually means in dollars. So you can see that my forecasting suggests that we have a significant jump in revenue. So we go from about $2.4 billion to just over $3.4 billion. So this is like a billion plus or plus 45% sequentially, and I mean, let's call it what is a shocking, almost 140% increase year on year. So wild growth rates. And then you can see here the energy segment crossed in 2024 or is just about a $10 billion business line. So this is a very substantial business on its own. Grew 73% year on year from 2023. 2023 grew 54%. So and before 40%, you can see. So the revenue growth in this business is accelerating, and you can see also solar. People always talk about solar, but solar is not really a focus area of Tesla. It's a very small part of the business, not a needle mover. It might be many. To be honest, I think it will never be a major needle mover because there are so many other business lines in Tesla that are growing, that are already much faster, they're growing very quickly. So even if for whatever reason solar would all of a sudden grow very quickly, it would have to catch up with all these business line, and at that point Tesla would be so large that even, let's say, a plus 2 billion or 3 billion from solar per quarter not going to make a big dent, because right now we're talking probably around 200 million or might be even less. Tesla actually stopped a few quarters ago disclosure of solar deployed, which tells you it has become a non-needle mover, because in corporate sort of reporting, the best practice is that you basically disclose items that you consider needle movers, and if as you remove certain items is basically a telltale sign that this item is not really a needle mover in your eyes anymore. There's another example I will touch on later. Then we get to the last big segment of Tesla. This is the service and other revenue. Sorry, the service and other segment. And on this slide, we look at the revenue, but I will discuss this in detail in part 3, because again, this video has already is already quite long. See you in part 3. Bye.